Good afternoon, everybody. I'm Richard Parkin. I'm Head of Pensions Policy at Fidelity International. Can I start by just asking how many of you love pensions? Put your hands up. Oh, a few. Okay, good. I thought it was just me. So one of the reasons our customers don't love pensions is that the rules keep changing. And I've been in pensions for 30 years now, and I think probably the changes we've seen over the past few years are unrivaled by anything before. So notwithstanding that, though, the changes I think have been largely positive, particularly for people who are in retirement or coming up to retirement. And what I'd like to do over the next half an hour is just talk to you about retirement planning, particularly in the context of retirement investing, and give you some do's and don'ts from our perspective of how you can make the most of the new rules and have a successful retirement. So what I'm going to cover is how those retirement choices have changed. We're going to talk a bit about combining income sources. Quite often people talk about guaranteed income or flexible income as two separate things that you will see that they're very much better when put together. We're going to talk a bit about income drawdown and just get back to basics as to what income drawdown actually is, because there's lots of misconceptions out there. And then the last two sections, we're just going to look at, first of all, investing in retirement. So how do I invest my income drawdown plan? But equally important, if not more important, how do I think about my withdrawal strategy? Yeah, so we will see that unlike saving for a goal, once you start taking income out of your pot, it has a pretty profound effect. So this is how life used to be, probably not so long ago. Generally, people would work up to retirement age, probably state retirement age. They might have a defined benefit pension, so a final salary pension. They'd get a tax-free lump sum, they'd get their pension income, and they'd get their state pension. I think the only real variation was some people were lucky enough to retire at 60 and so had to wait a few years before the state pension kicked in. Things have changed a lot since then. So there's three big things I think have happened to change that picture. So the first off is the rise of what we call DC pensions. So the final salary pension's a defined benefit. You know what you're going to get. The benefit you get is defined. They've been replaced with defined contribution pensions, where all you know is what's going into your pot. The pot's invested, and actually you get out whatever is available at the end. And certainly most companies now are offering DC pensions as the main pension scheme for their employees. I'm sure many of you here will have DC pensions either at work, or you'll have personal pensions, which are just another form of DC pension. Pension freedom. So this is what happened in 2015. So this is where George Osborne famously stood up and said nobody need ever buy an annuity again, and promptly nobody ever did. So there's been some big changes about how people are able to access their pension pots, and effectively once you hit age 55 you can take what you want from your DC pot when you want it and in the form you want. If you want to stay invested and take an income, you can. If you want to buy an annuity, you can. If you want to take a cash lump sum, you can. And then the final one sounds really dramatic, but is actually really happening. So it's this we call the death of retirement. So the idea that you get to a point in your life where you hang up your boots and hit the golf course just doesn't seem to be happening anymore. People increasingly are easing out of work, changing careers, and actually they don't perhaps fully retire until much later in life. And there's a real disconnect between when people start needing to take money from their retirement savings and when they stop working. And actually pension freedoms has made that much easier for people to manage. So this is what that picture looks like now, and this is kind of a bit of prediction about how the new future will look like. But this is what we see our customers doing today. So as well as the earned income that we had before and the blue defined benefit pension, we've now got one of these DC pensions coming in. And because of the pension freedoms, people can and are accessing much earlier on. So we see customers maybe sort of 5, 6, 7 years away from retirement starting to dip into their pension, maybe take some money out, pay off the mortgage. And then what we see happening is that as people get to the sort of 65, they'll probably slow down, maybe they'll go part-time, maybe they'll have different careers. They're carrying on earning a lot of people still have these defined benefit pensions, so that will kick in. And actually, it's probably not until a bit later on, until people have finished working, that they actually say, well, I'm going to want to take that DC pot and turn it into an income. So people are thinking much more about how they can combine all their different sources of income to meet the way they want to live their lives, or in some cases, the way they have to live their lives. I think there's many people who would love to retire at 60 and hit the golf course, but unfortunately aren't in a position to do so. So I just wanted to talk about this distinction between guaranteed and flexible income, so if you like, between annuities and drawdowns. So often it's presented as a binary choice, but if we think about what people are trying to do in retirement and what they might need from their savings, we can think about them in five different ways. So first one, and quite most common one perhaps, is people want an income for life. You know, they want to have money that's not going to run out before they die. And they also want some certainty. They want to know how much they're going to get each month so that they can plan and budget sensibly. Inflation, so we heard a couple of days ago, inflation's hit 3%. It looks like that's going to be around with us for some time. So protecting against inflation is important, particularly when you think that a 65-year-old today can probably expect to live for 25 years. If you've made it to 65, your average life expectancy is about 89. So good news on one hand, bad news in that you've got to plan for a much longer horizon. And increasingly people want flexibility, particularly as people have more active retirements. They want the ability to take money, as and when they need it, and certainly some of the guaranteed pensions don't fit that. And then finally, and this is one that kind of went a bit unnoticed with all the pension freedom, people want to leave their pensions behind. The government changed the inheritance tax rules about pensions, which means that you can actually leave your pension behind, and it's certainly free of inheritance tax, and actually if you're unfortunate enough to die before 75, it's completely tax-free. So increasingly what people are doing is saying, well, actually I'm going to spend all my other assets, spend down my estate and keep my pension intact. So what do our different types of income, how do they help me with that? So guaranteed income, such as state pensions and final salary pension schemes, are great at giving you an income for life. That's what they do. An annuity is the only financial product that will guarantee you an income for life, and people kind of lose sight of that. They're also pretty good at giving you certainty. You know how much you're going to get, and generally they do give you some inflation protection. State pension is great for inflation protection. It's got the triple lock, so it goes up by the higher of earnings or inflation or 2.5%. Defined benefit schemes are getting less useful for protecting against inflation, but they do provide some cover. If we look at pension drawdown or income drawdown and just generally investment income, we find that it ticks the boxes that guaranteed benefit doesn't. So you can get inflation protection, particularly investing long term. It's not a guarantee, but it is possible to grow your portfolio and keep up with inflation. You've certainly got flexibility, so you can take what you want when you want it, and you can certainly leave it behind for loved ones. Generally with defined benefit pensions, you will get a pension for your spouse, but once they've died, then there's no inheritance. That's the end of the story. So I'm sure it doesn't take a huge synaptic leap to realise that by putting those together, you can tick all the boxes, and certainly that's what we think is going to be appropriate for many people. So just looking at the retirement choices bit of this talk, so the do's, make sure you've got a clear retirement plan. We see so many people jumping into taking money out of their pensions without thinking about their long-term retirement plan. And maybe they don't know all the details, but it's important to recognise the choices you make now will have impacts later on. So you've kind of got to know that you can take out that £10,000 to buy a new kitchen before you do it. And at least that way you'll know what impact it's having. And in terms of thinking about combining income, the basic rule that we have is say work out what your essential expenses are and make sure they're covered by guaranteed income. Whether that's state pension or defined benefit or even buying a bit of annuity to cover that. And the reason for that is not just because it helps you sleep at night to know you'll always have somewhere to live and something to eat, but it allows you to take on more investment risk. If you've got your whole retirement savings invested in the market, you're going to have to be cautious, because that's all you've got to live on. If you've got a base of guaranteed income, you can afford to take a bit more risk, because you know that no matter what happens in the markets, you'll still be able to eat and have somewhere to live. So it's not just about playing safe, it's allowing you to really exercise your investment choice. Don't take cash from your pension unless you really need to. So there was a really nasty change of rule that came in actually just a month ago. It got held up by the election, but government is continuing to push it through, which says that once you've started taking money from your pension beyond the tax-free piece, you will find that you can only put £4,000 a year into your pension. And we're seeing lots of customers getting caught out because they've cashed in an old Scottish Widows policy so they can go on a nice holiday, and have suddenly find that they're stopped from saving as much into their pensions, and their retirement plans have really been messed up. And don't be in a rush to give up guaranteed income. You know, everybody's thinking about transferring final salary pensions, and it looks amazing. You might have a £20,000 final salary pension if you're lucky. You get a transfer statement and it tells you could have £700,000. That looks like a huge amount of money, and it is, but actually it may not represent the value of the income you're giving up. Guaranteed inflation-linked income is really valuable. To buy the state pension today would cost you about £265,000. Yeah? So you say, well, it's only £8,500 a year. Well, it is, but it's inflation-linked. £265,000 at least to replace that on the open market. So let's start taking a look at drawdown. So as I said, it's a bit misunderstood. People think, oh, drawdown's taking income, and it is, but actually all drawdown means is you've started accessing your pension savings. So whether that's in a self-invested personal pension or a DC pension plan. So here we've got our pension pot. We've taken a little bit of tax-free cash out the top, which is how you start accessing. And going into the top, we've got investment growth and income. If we're unlucky, we've got some investment losses draining out the bottom, and then we're taking retirement income or retirement lump sums. And obviously the trick is to make sure that these two don't drain your pot before you want to. So if we think about it in those terms, the questions we can ask about drawdowns, okay, well, not only how should I be invested, how should that pension pot be put to work, but what is my withdrawal strategy? How much can I afford to take out? And the way that we try and think about it, this is slightly oversimplifying it, but I hope it will make sense to you, is we think of three different types of investor. So the first one we call empty my pot. So these people are saying, well, actually, I've got this pot of money, I just want to get it out as quickly as I can because I'm going to use it for current expenditure, maybe pay off the mortgage. They may not want to take it out all at once, because if you do that, you'll pay a lot of tax. So we see people saying, right, I need to sort of stage the withdrawal over the next 2, 3, 4 years. And for those people, investment risk is a bit of a no-no. They want to be certain that when they come to take the money, it will still be there. At the other end of the scale, we've got the leave it behind people. So as I said, a lot of people are looking at keeping their money invested and passing it on as an inheritance. They may want to take some income in the meantime, but they're probably just taking the income that comes off the investment portfolio rather than dipping into the capital. And to a large extent, these investors are very much like people who are saving for retirement. Investment risk is their friend. Yeah? Over the long term, investment risk will mean higher returns, and therefore is a good thing for them. In between, we've got the make it last people. So these are people who are saying, all right, I've got a pot of money and I want to turn it into an income that's going to last me probably for as long as I live, or certainly a good way into that. How do I do that? And actually for these people, investment risk is a bit of a double-edged sword. On the one hand, they need investment risk to get some growth. There's no point staying invested if you're just going to stick it in cash. Well, certainly you're not going to get any growth from that. So they need to take on some risk. But if they take on too much risk, it can mean that they run out of money too soon, because as we saw in the slide before, if you start losing money, particularly if the markets go down and then you're taking investment income out as well, you can find that pot empties very quickly. And once it's started emptying, imagine a bucket with a big hole in the bottom. Doesn't matter how fast you're filling it up, once it started emptying, it's very difficult to get it full again. So that's broadly how you might think about it. And what does that then mean in terms of the types of investments people would have? So we see the empty my pot people, really sort of a lot of them sitting in cash and saying, well, I'm just going to stay there and that's the thing that's going to give me certainty. Some people might go into fixed income funds or even cautious multi-asset funds, what we call cautious balanced funds, so a bit of a mix of investments but not much risk. Of course, there are absolute return funds which aim to protect your money. As I'm sure many of you will know, absolute return is absolute return until it isn't sometimes, so just be wary of those, but they do potentially have a role to play. The leave it behind, well, again, long-term investors really, so they probably are thinking about 20, 30 years investment, so equity-based funds are certainly likely to deliver good returns, but they may look at things like equity income if they're going to be taking the income off to live on themselves. So they may be protecting the capital and wanting to grow the capital long-term, but actually looking for a bit of a higher income. And then finally, the make it last people, you'll have seen possibly a rise in multi-asset income funds, and so these funds aim to deliver a reasonable level of income, but at the same time protect, or certainly the ones that are good for retirement, protect what we call downside risk. So aim to try and protect your capital. And they do that by investing across a range of investments, bit of equity, so they get the benefits of diversifying across investments, but then actively managing based on market views. So these funds can generate a decent level of income, but also making sure that your capital stays reasonably safe, so that if you are trying to draw income out of it, you're not doing that at the bottom of a bad downturn. I think I've one before that. So in terms of the do's and don'ts of retirement investing, work out what's important to you. And actually, you may say, well, I'm a bit of all three of those. Yeah, I want to get a big lump out now. Yeah, I want to leave some behind, and I want to turn some into income. So you can do all three of them, and it might help to think of those as kind of three separate pots with three separate strategies. But you have to be prepared to adjust your goals, and we'll look at in a minute about the need to be flexible and what the benefit of that is. But there's no point going into income drawdown if you haven't got the ability to flex your goals, because investment returns aren't guaranteed, as we know, and so you have to be prepared to deal with the rough as well as the smooth. Downside risk, so what do I mean by downside risk is the risk of actually a fall in the value of investments. So volatility is one thing where investments go up and down. What we're really focused on is them actually falling in value, so going below zero. If you're taking money out after a fall, then you'll just compound that loss, and you won't have to, it's going to be much more difficult to recover from that. It's not just a case of making back what you lost, you're going to have to make back the income you've taken out as well. And don't get focused on yield. Yes, retirement investing, is about income for a lot of people, but you'll find that if you focus just on a fund's yield, that may come at the expense of capital. So a number of funds deliberately focus on maximising yield, and the cost of that is an erosion of capital over time. And that may be fine for you, but just make sure you understand what that impact is. Because your capital base will be what's generating income into the future, and if you're eroding that, your ability to generate future income will diminish. So I'm just going to finish off by looking at the other side. So we talked, drawdown is about two things, as I said. One about is how you invest, the other is about your withdrawal strategy. And you can't read an article about drawdown without somebody talking about you running out of money. The popular belief is you go into drawdown, you make some risky investments, you take out too much money, and everybody's going to run out of money before they die, and people are going to end up destitute. Actually, that's very far from the truth. Both, markets where drawdown's been around for a lot longer, you see the opposite, and that's what I'd like to try and explain. So I've got a chart here which shows, it's actually a tool off the Fidelity website which helps you work out or helps you understand how much you might be able to withdraw. And I just say this is an example, not a recommendation. But what we do and what most people who provide these types of tools or provide this type of advice do is say, we want to give you very high level of certainty that you're not going to run out of money. Yeah? So in this case, we've got a 65-year-old male who's got 100,000 to put in. And what we do is we work out, we say, right, what's the most income that you could take each year but still be 90% certain or very, very certain that you won't run out of money. So we say, well, what would happen in a really bad market? And then we work out the income on that. And you'll see here, this orange line is a poor market. And we've calculated that number by saying, right, well, you know, what's the most we can take such that it doesn't run out just before I'm expected to die at 89? Yeah. So we're planning for a poor market, and that's great. Yeah. So that means in 9 times out of 10 or 19 times out of 20, you'll be fine. But the flip side of that is that actually, if markets perform as they're expected to, the average market means that if you do die at 89, you've still got probably £65,000 left. Now that might be fine if you want to leave it behind, but we're talking about people who are wanting to make their pot last. If the markets have done really well, you actually end up with even more money than you started with, a lot more than you started with. And that is not a good outcome if your intention was to have a good retirement. Yeah? Any money that's been left when you die is money that you didn't get to spend when you retired. Yeah? So the way we like to think about drawdown is a bigger question about, rather than how do I just make sure I don't run out of money, is how do I use drawdown to help me get the most from my retirement savings for as long as I'm alive. Yes, it's about making sure your money won't run out, but it's also about making sure you don't leave lots behind. And the final point is, how can you get your money when you're well enough to spend it? What we see is that generally people spend a lot more in the early years of retirement when they're more active, they've got more things to do, dream holidays, paying off houses, buying caravans, holiday homes, whatever it might be. As they get older, they do tend to have a lower income requirement. Yeah? So having a plan which gives you lots of money later in life may not be great, because you may not be in the best of state to spend it, and you may find that many of your friends aren't around to help you spend it either. So how do we then think about drawdown? How do we get away from this idea of just being super conservative? And it goes back to what I was saying about being flexible and being prepared to make changes to your goals. So let's look at 3 withdrawal strategies. So the first one we'll call the wait and see. Yeah. So with that, I start off, I've calculated my income level, starting level income using that tool. I've said, right, I'm going to start off with a very safe plan and see how I go. Yeah. And if the markets go well, and they probably will, you can increase your income over time. Yeah. So, and that's okay, but the challenge of that will be that you may not be well enough to spend it. So it doesn't really help. And actually, you find you can't increase your income fast enough to make that work. The next strategy might be what we call, so play the 50-50 game. So rather than planning for a poor market, plan for an average market. Yeah, so we can start off with a higher level of income, but what we need to be prepared for, that if the markets do well, I can take a bit more, but if they don't do well, then I'm going to have to take a bit less. But what you'll find is that means you can get more money out, and you can get a bit more money out earlier on. You just need to be flexible. And actually, given what we were saying about needing to have more income earlier in retirement, even if the markets don't do so well, that's probably easier to cope with. And then the final one is saying, okay, well but I really want to spend more at the start. And so I think about, I'm sorry, this chart has jumped out of place. So the idea is you set your income higher in the early years, but then plan for it to go down later on in your retirement. And again, you assume average market performance, so you have to be prepared to be flexible. And sorry, the chart's really got whacked. The point here, though, is because you're taking a lot out up front, if the markets do start working against you, you're going to have to reduce your income really quickly. So that's pretty high risk, yeah, but it does mean that you get to spend what you want a bit earlier on. So from all of that, I think the real point is to make is, if you're going into drawdown, you need to be prepared to be flexible, and actually by being flexible you can get much more out of your income drawdown plan than otherwise. So as we said earlier, make sure you've got plenty of guaranteed income, because that will give you your fallback position to cover your expenses, and review your income regularly. So drawdown is quite hard work. You know, not only you've got to keep your investment strategy reviewed, but you've got to keep looking at that withdrawal strategy, keep reworking out to see if you're on track. And don't underestimate how quickly markets can turn bad and erode your savings. And you know, just a simple rule like if the market goes down, you cut your savings back will help. And just don't use drawdown for lifetime income if you can't be flexible. You know, we do see people jumping into drawdown but not being prepared to take the risk or the flexibility. If you're not prepared to take the risk and be flexible, then you probably want to look at guaranteed income. So just to summarise everything I've said, so big rule number one, make sure you've got a plan. Yeah, and if you can't make that yourself, then get some help. The decisions you make in retirement are often irreversible. Yeah, so taking cash is an irreversible decision. You probably find you can't put it back in, and you certainly won't be able to get the tax back that you paid the tax man. Combine different income sources to meet those needs. Make sure you've got a good mix of meeting your day-to-day expenses, leaving things behind, but giving yourself some flexibility. I won't say that again, but it is a central rule to make sure you're covered. And think about your investment strategy. Again, we do see people where they'll jump into their favourite fund because that's been the fund that's worked really well for them as they've been saving for retirement. It might be the fund that really destroys their retirement. So make sure you're thinking about whether the funds you're buying into are appropriate for the goals you've got. And keep looking at those investments. Make sure your withdrawal rate is consistent. There's tools online on the Fidelity website that can help you do that. And make sure that you're not taking too much risk, but also that you're not being too cautious. And finally, get some expert help. So I know many of you in this room, by the fact you're here, will be pretty confident. I'd suggest that if you're ever going to get help with your finances, retirement is the time you want to do it. Because it's a complicated area. There's lots of money to be lost in tax and wrong decisions. There's also a lot of money to be made. So you can find taking advice at this stage is often worth it. So that's me done. Just to say that in terms of how Fidelity can help you with that, so we, as well as being a personal investing service, we do have retirement specialists. They can give you free guidance on retirement matters. They can also, if you need it, give you advice, and we've got our stand just outside here where we've got retirement specialists and our relationship managers there who can talk to you about that, and there's plenty of material on the stand that you can take away with you. I'd also encourage you to talk to them about the wealth service. So for those of you who are lucky enough to have 250,000 or more, you can get an enhanced service with quarterly investment reports and your own relationship manager. And if you haven't got time to talk to anybody today, do check out the website fidelity.co.uk. You'll find that drawdown tool and plenty more material on there to help you plan for a successful retirement. Thank you.